Welcome to the Deep Dive. Today, we are wading into one of the most polarizing questions on the market right now, facing a company called BigBear.ai, ticker BBAI. As global geopolitics drive a new supercycle in defense spending, BBAI is aggressively positioning itself to become the operational cortex of the U.S. defense sector, with ambitions squarely aimed at evolving into the next Palantir. They are selling a powerful vision of sovereign AI.
It is a phenomenal narrative, but here is the central tension we must address for you, the listener. Is this company truly poised to capture the future of algorithmic warfare and grow into a defense tech giant?
Or is the recent aggressive market hype simply masking a core business that is currently shrinking, held afloat by continuous dilution and some pretty aggressive financial engineering?
That's the core question.
When we anchor this deep dive to the market close of December 6, 2025 at a share price of $7.02, giving it a nearly $3 billion market capitalization, the disconnect between the market's hope and the company's current financial reality is, well, it's stark.
It's more than stark. We're talking about an intrinsic value derived purely from cash flows that sits at roughly $3.85 per share.
Wow.
So the market is betting on a success story that is currently, 82% ahead of its fundamentals?
An 82% premium for the story.
Our mission today is comprehensive. We are going to synthesize BBAI Holdings, Inc.'s entire strategic pivot. The shift from a traditional services contractor to a provider of AI-powered decision intelligence for national security.
And we'll analyze their highly unique financial maneuvering, specifically their dilution as a strategy approach, and place them firmly within the high-stakes, high-barrier-to-entry world of defense technology where every contract delay can cost millions.
Exactly. We've assembled a massive stack of sources here, detailing the arithmetic, the flat revenue, the dangerously low margins, and we're going to contrast it with the narrative they're expertly selling about future growth and strategic acquisitions.
Our goal is to equip you with the full picture, allowing you to decide if you want to pay that 82% premium for potential or if you agree with the current fundamental assessment. Okay, let's unpack this. Part 1, Chapters 1 to 3, Business, Management, and Financials. Chapter 1, Business Understanding.
To understand where BigBear.ai is going, you have to understand where they came from.
Right.
The foundation of the business is, it's messy because the company is in the middle of a massive, painful business model transformation. Historically, it was a defense services contractor.
That was the legacy model.
Yes, and it still accounts for a significant portion of their revenue, housed in their cyber and engineering segment.
And when we talk about a defense services contractor, we mean a low-margin, high-labor operation.
That's it.
They were essentially staffing up on cost-plus contracts, where the government reimburses them for costs, plus a small, predetermined percentage fee. They provide cleared engineers and data scientists.
It's sticky work, sure, but it's inherently unscalable, and crucially, it is totally subject to the slow, unpredictable rhythm of the federal budget cycles and continuing resolutions.
That unpredictable rhythm creates immense volatility.
It does, and we saw the direct consequences of this in the third quarter of 2025, when volatility and delays in specific U.S. Army contract volumes led directly to a significant revenue miss for that segment.
So when your revenue is tied to bodies and seats and the timing of a congressional vote, you're constantly managing this type of swing.
It makes long-term forecasting nearly impossible.
The pivot, though, is the core of the entire investment thesis.
It is.
They are making an aggressive, almost desperate shift toward the higher-margin analytics segment. They want to move entirely toward proprietary software licensing, true AI as a service, and transaction fees.
This is the structural change that investors expect from a software company, not a staffing firm.
And this shift isn't happening organically, is it?
No. It's being purchased. They have meticulously assembled their product portfolio through targeted acquisitions, aiming to create a complete decision superiority stack for their customers. It's a suite of specialized capabilities intended to provide actionable intelligence faster than traditional systems.
Okay, let's look at the key products that are supposed to drive this bull case, starting with Ask Sage. This is a pending acquisition announced in late 2025, and management calls it agentic AI. Why is that $250 million price tag worth it?
Ask Sage is arguably the single most critical strategic play BBAI has made because it solves the biggest security bottleneck for classified users of generative AI.
Okay, break that down.
Large language models are amazing productivity tools, but if you work at the DoD or an intelligence agency, you absolutely cannot push top-secret data into ChatGPT or even commercial models running on general clouds.
Of course not. It creates an unacceptable risk of data leakage.
Exactly. So if the data is classified, the LLM is off limits.
So how does Ask Sage change that?
Ask Sage provides a secure, accredited repr. You can think of it as a highly specialized, federally certified airlock.
Got it.
It allows defense users to ingest highly sensitive data into accredited generative models running within a classified enclave. It solves a productivity problem letting analysts use cutting-edge AI without creating a security problem.
So that's why they paid roughly 10 times projected annual recurring revenue for it.
Yes, because it gives them immediate entry into this high-margin, accredited generative AI space, leapfrogging competitors who lack the authority to operate, or ATO.
Moving from abstract intelligence to physical security, let's discuss Pangiam.
Pangiam, which they acquired earlier, is their vision AI engine focused on digital identity. This is deployed operationally in high-traffic, sensitive environments.
Like facial recognition and anomaly detection.
Exactly. And automated vetting systems used at major ports of entry across the U.S., such as Chicago O'Hare International.
So Pangiam moves BBAI beyond back-office analysis and into edge applications.
Yes, real-time processing of physical security data where decisions need to be made instantaneously, like flagging a potential security risk immediately upon entry. This is high-visibility, high-stakes technology.
And then we have the cornerstone government contracts like GF, Global Force Information Management.
GFIM is BBAI's flagship prime contract with the U.S. Army. This is not a small, siloed project. It is the comprehensive, real-time dashboard for the Army.
The whole dashboard.
The whole thing. GFM provides a holistic, unified, real-time view of force readiness, manning levels, equipment status, and logistics. It's what Army leadership uses to instantly assess readiness and decide where and when to deploy resources globally.
So this is crucial operational software.
It is, and it gives BBAI significant strategic importance within the defense structure.
Finally, we need to touch on Pro Model. It's less flashy than the generative AI plays, but it provides a unique and vital capability.
ProModel is the legacy but highly specialized simulation tool. Its value lies in creating sophisticated digital twins. For industrial clients or the military, this means they can simulate the outcomes of complex events, like a global supply chain disruption or a massive troop movement, before they commit physical resources.
So predictive logistics and optimization.
Precisely. That capability sets BBAI apart from companies that are only focused on descriptive or diagnostic analytics. They can model the future, not just describe the past.
So we have a clear picture of the product stack. Now let's define their market position. With a $2.98 billion market cap, they sit in a tricky middle ground.
They do.
They are much smaller than the traditional prime contractors, but they are absolutely dwarfed by their primary peer, Palantir, which is operating north of a $100 billion market cap.
That scale difference is important, but it's also deceptive. BBAI has carved out a specialized niche as the pure-play classified AI alternative.
Oh, so?
They are agile enough to deploy commercial-grade technology faster than a Lockheed or a Raytheon, yet they possess the deep security accreditations that a typical Silicon Valley startup, even one flush with venture capital, simply cannot replicate overnight.
So that specialization is their core defensive strength.
It is.
And that defense leads us directly to their central value proposition. Clarity for the world's most complex decisions, enabled by what they call the sovereign AI moat. This is where the investment story hinges on geopolitics.
It absolutely does. The sovereign AI thesis posits that globally, nations are realizing that AI infrastructure, sensitive algorithms, and the associated classified data must be treated as critical national territory.
They can't just outsource it.
They cannot rely on foreign entities or commercial platforms that lack the necessary clearances. BBAI's existing accreditations, the authority to operate for top-secret environments, is their primary multi-billion-dollar intangible asset.
It's not just a nice feature, it is an economic barrier to entry.
Right.
It's the difference between being invited to bid on the most lucrative defense contracts and being entirely locked out.
Precisely. To put the industry context in perspective, we're living through a supercycle in defense AI, driven by accelerating geopolitical competition. The strategic shift toward algorithmic warfare, where the side that analyzes data and makes a decision fastest wins the conflict, is driving unprecedented capital expenditure.
And the financial catalyst they are explicitly betting on is the potential one big beautiful bill for the 2026-2027 defense modernization budgets.
If that anticipated multi-billion-dollar funding injection materializes, which analysts are widely expecting given the current global climate, BBAI is perfectly aligned to capture capital earmarked for border security, predictive logistics, and autonomous systems.
That potential future funding is the engine driving the stock's current premium valuation.
No question.
When we look at competition, Palantir is the benchmark.
Yep.
How does BBAI compete against the company that essentially defined the GovTech AI category?
Well, Palantir possesses superior scale, superior profitability, and a user base that is deeply entrenched, particularly with their Foundry platform.
So BBAI has to differentiate.
They try to differentiate primarily through modularity and cost-effectiveness. Palantir often requires agencies to adopt its entire monolithic platform, which can be expensive, and requires a total system overhaul. BBAI offers specific accredited solutions like Ask Sage or Pangiam that agencies can plug into existing infrastructure.
And what about the massive incumbents, the traditional primes like Northrop Grumman, Boeing, or Booz Allen Hamilton?
They exist in a complex frenemy ecosystem.
Frenemies, okay.
BBAI often partners with the primes as a highly specialized subcontractor to access massive, multi-year, multi-billion-dollar projects. But simultaneously, BBAI's core strategic goal is to develop agile proprietary software that ultimately displaces the prime's often clunky legacy systems.
So it's a delicate balance of collaboration and internal competition.
A very delicate balance.
You mentioned the immense barriers to entry, the regulatory and logistical moats. Let's expand on that. What does getting an ATO actually entail, and why is it such a significant hurdle?
An authority to operate, or ATO, is a formal approval from a federal agency, often the DoD, certifying that an IT system meets specific security and risk management standards to operate on their networks.
And that's not a quick process.
It's grueling. It requires years of auditing, massive infrastructure investments, and tens of millions of dollars in compliance costs. A new competitor cannot simply write good code. They must achieve a level of governmental trust and security compliance that takes half a decade or more to build.
And the logistical barrier. Maintaining a high-clearance workforce must be brutally difficult in the current tight labor market.
It is. The highest security clearances, top secret SCI, are a finite resource. They require intensive background checks and continuous monitoring.
So BBAI has to pay up for that talent.
They have to offer premium compensation to retain these cleared engineers, which directly impacts their labor costs and, as we will discuss shortly, puts immense downward pressure on their margins in that services segment.
So these barriers are the real foundational moats protecting their business.
They are.
Okay, that gives us a detailed map of the business structure and the defensive positioning. Speaking of the cost of that transition, let's talk about the people funding it and the leader driving the strategy. Chapter 2, Management Evaluation.
The BBAI story of 2025 is fundamentally a story of leadership transformation and aggressive strategic redirection.
Right?
We saw the transition in January 2025 from Mandy Long, who was focused on stabilizing the post-SPAC operation, to Kevin McAleenan, who was brought in specifically to signal and execute offensive growth.
So Long did the dirty work of cleaning up the messy SPAC merger, winding down unprofitable legacy contracts, and resetting the cost structure.
Exactly. But McAleenan is the one building the cash fortress and driving the current M&A strategy.
And his background is highly unusual for a tech CEO.
It is, and it's the key to understanding the bull case. McAleenan is non-technical but deeply operational in the exact niche BBAI needs. He served as the former Commissioner of Customs and Border Protection and even briefly as acting Secretary of Homeland Security.
So he doesn't write code, but he knows the customer, the DoD, DHS, and the intelligence community better than almost any traditional Silicon Valley executive.
That's it. His personal brand and network act as a proxy for trust and competence within Washington. He opens high-level doors in the defense and national security establishment that a typical, purely commercial tech CEO wouldn't even have access to.
And he came from Pangiam, right?
He did. His previous company, Pangiam, was acquired by BBAI, demonstrating his entrepreneurial and M&A competence within this highly specialized GovCon space.
Let's discuss communication. Management has been notably candid about the challenges. They transparently acknowledged the Q3 2025 organic revenue decline of 20%, laying the blame on specific named Army program delays.
Right. That level of transparency is rare and appreciated by investors. But transparency is good, but we must also be critical of their reporting standards. We have to critique the heavy, arguably misleading reliance on non-GAAP adjusted EBITDA as their primary measure of operational success.
This is a common practice in growth tech, but it deserves scrutiny. Why is non-GAAP EBITDA problematic here? What specific costs are they routinely excluding that investors need to be aware of?
The most notable exclusion is stock-based compensation, or SBC.
Okay.
In a growth company that relies on issuing stock options and restricted stock units to pay high value, cleared engineers, especially during M&A deals, SBC is a massive, real expense that hits shareholders through dilution.
So by removing it from adjusted EBITDA, they can paint a picture of operational profitability that simply isn't reflective of their total capital cost.
Exactly. It allows management to sell a rosier profitability story than the hard GAAP figures permit.
This brings us to their capital allocation strategy, which centers entirely on M&A. We discussed Ask Sage, but let's talk about the financing structure. The company is actively pursuing dilution as a strategy. That's a massive ask for existing shareholders.
It is the most shareholder-unfriendly strategy in the short term, yet management views it as essential. They have aggressively utilized at-the-market, or ATM, offerings,
Which is essentially selling new shares into the public market whenever the price is high.
That's right, and they've used it to raise vast amounts of capital. This has successfully built a massive $715 million cash fortress, which they strategically refer to as dry powder.
This cash fortress de-risks the company against every operational hiccup. Federal contract delays, government shutdowns, integration issues. But how do they sell this continuous dilution to long-term shareholders?
They sell it as a necessary evil to reach critical mass.
Okay.
The strategic calculus is clear. The legacy services business has dreadful 22.4% gross margins. The only way to achieve genuine financial leverage and profitability is to layer on massive amounts of high-margin, sticky software revenue, like Ask Sage.
And you can't buy those assets without significant capital.
You can't. They argue that sacrificing current per-share value is required to achieve the scale necessary to bid on and win future multi-billion-dollar prime contracts.
So it's a necessary sacrifice, but let's look at the result. Return on invested capital, or ROIC.
Well, right now, the ROIC is deeply negative.
Which makes sense.
It's a natural consequence of operating losses, combined with the massive amount of goodwill generated from acquisitions like Pangiam and Ask Sage. Goodwill is an intangible asset on the balance sheet, reflecting the purchase price paid over the fair market value of the assets acquired.
And it shows they're paying a steep premium for strategic growth.
A very steep premium.
If the ROIC is negative and they are diluting shareholders, why aren't investors rioting?
Because the market believes management's thesis: scale first, profitability second. They must reach a certain revenue threshold, that critical mass, before the software leverage kicks in and starts covering the massive fixed costs of maintaining those ATO clearances and the high-level security workforce.
So they're betting that the long-term payoff from high-margin recurring software will eclipse the short-term losses and dilution.
It's a very high-stakes, growth-at-any-cost approach.
That strategy is now running directly into the reality of the company's current financial statements. We need to look at the arithmetic, which, frankly, currently runs against the entire narrative. Chapter 3. Financial health.
Let's lay the groundwork. We established the market cap is $2.98 billion. Now, let's determine what cash flow that price tag is buying. And we must look at the top line first. Revenue stagnation.
The revenue trajectory over the past 4 years, from 2021 through 2024, is essentially a flat line, hovering narrowly between $146 million and $158 million.
Right.
This is critical. BBAI has been a zero-growth company for 4 years.
And it gets worse. For the current fiscal year, 2025, management projects a revenue decline of 10 to 20%, estimating revenue will fall to between $125 million and $140 million.
A decline.
A decline, and it's driven purely by the contract completion and delays we mentioned in the lower margin services segment.
So if the core business is shrinking organically, the entire expectation of a major 2026 rebound hinges completely on 2 external factors.
You big ones.
The perfect and rapid integration of the Ask Sage acquisition and the multi-billion-dollar injection from the anticipated defense funding bill.
Without those 2 catalysts, BBAI is contracting rapidly.
Exactly. Now let's look at profitability. Because this is where the financial structure reveals its core weakness, starting with gross margin.
In Q3 2025, the gross margin was a critically low 22.4%.
22%. That is the figure that defines the company's financial struggle.
It really is.
True software companies trading at this kind of premium should have margins in the 70% to 80% range. 22% sounds like a highly competitive industrial manufacturer, or, as we said earlier, a construction firm.
It signals a profound lack of true software leverage. There are costs of delivering the service, primarily high labor costs for cleared personnel, and the necessary infrastructure for security are far too high relative to the revenue they bring in.
And consequently, their operating margin is deeply negative.
Deeply. They reported an operating loss of $21.9 million in Q3 2025 alone.
Wait, if the operating loss was $21.9 million, how did I see a headline that BBAI reported positive net income of $2.5 million for Q3 2025? Is that a sign of the turnaround finally kicking in?
That is the perfect question, and the answer is absolutely not. This is the accounting mirage we need to highlight for you.
Okay.
That positive net income figure was entirely driven by a massive, non-cash, $26.1 million accounting gain.
A non-cash gain.
Yes. This gain resulted from the revaluation of warrants and other derivative liabilities on their balance sheet, a common, complex financial outcome of their prior SPAC structure and debt arrangements.
So it wasn't cash from a customer, it was simply a balance sheet adjustment.
Correct. If you strip out that $26.1 million non-cash gain, the company is still deeply unprofitable. Investors must always look past the headline net income figure and focus on the operating loss and, more importantly, free cash flow.
Speaking of free cash flow, how sustainable is the operation if they keep the burn rate up?
FCF has been consistently and massively negative. They burned $20 million in 2021 and $50 million in 2022, and they have continued burning cash throughout 2025.
And this negative cash flow is why those aggressive equity raises, the dilution strategy we discussed, are necessary.
It's the only reason they can operate. They require the issuance of new shares just to maintain liquidity and fund the expensive M&A deals in core operations.
Let's break down that $21.9 million operating loss in Q3 a bit further. Where exactly is the money going? Is it all R&D to develop Ask Sage internally?
No. The loss is distributed across several key areas that are required to maintain their moat. While R&D is a component, a massive portion goes into selling, general, and administrative expenses, SG&A.
So salaries, overhead.
High salaries and stock compensation for the sales team, the management team, and, critically, the continuous compliance and overhead costs required to maintain those ATOs and security clearances across multiple government facilities.
So these are fixed costs that are suffocating the revenue stream because of the low 22.4% gross margin on the core business.
Exactly. You need massive revenue growth to finally scale over that cost base.
But the cash fortress does exist. They have a record high of $715 million in cash on the balance sheet. That must provide immense stability.
It is their single most powerful financial strength. That cash makes them net debt negative and gives them an exceptionally strong current ratio, estimated at over 5.0x.
Wow.
This buffer is critical. It acts as an absolute floor against catastrophic risk, insulating them from government shutdowns, payment delays, or integration failures. This $715 million is what allows them to continue the speculative strategy without immediate fear of collapse.
The stability's there, but the operational performance is not. This brings us to valuation. We can't use price to earnings since operating earnings are negative, so we turn to price to sales.
P.S. Yes. Based on 2025 estimated sales, BBAI is trading at an expanded multiple of approximately 22.4 times sales.
To put that premium into context.
The undisputed category leader, Palantir, is currently trading between 30 and 40 times sales, but Palantir is growing faster and is yet profitable.
Okay.
Meanwhile, specialized peers like C3.ai are trading in the range of 6 to 9 times sales.
So BBAI is getting a Palantir-light valuation premium, but for a company that is currently shrinking revenue and is deeply unprofitable operationally.
The market is pricing in absolute aggressive perfection in future execution that is nowhere near reflected in current data.
This is why we must perform an intrinsic valuation using the discounted cash flow, or DCF model.
Right. The DCF attempts to value the actual cash-generating potential of the underlying business by projecting future free cash flow. It cuts through the hype.
and the assumptions needed to make a DCF analysis even remotely close to the current price had to be extremely bullish.
Oh, they were highly optimistic. We modeled an aggressive 25% compound annual growth rate for 5 years straight.
25%?
Yes, this assumes the full success of the Ask Sage integration, massive margin expansion, and the timely arrival of the defense supercycle funding. Given that the current organic revenue is declining by 20%, 25% CAGR is a leap of faith.
And the risk profile. A high-growth, speculative tech stock in the defense sector must be volatile.
Absolutely. The volatility is extreme. The stock's beta is 3.19.
3 times the market volatility.
Over 3 times. That volatility requires us to use a significantly high discount rate, or WACC, of 12.5%. This high WACC reflects the high risk of the entire operational strategy.
So even with that extremely optimistic 25% CAGR, and assuming the company turns free cash flow positive in the next few years, what does the fundamental value calculation tell us?
Because of the structural low gross margins, that 22% figure, very little of that aggressive projected revenue actually converts into true free cash flow. We project FCF only turning marginally positive around 2027 or 2028.
And the result?
The resulting estimated per share value is approximately $3.85.
Let's state that clearly for the listener. The stock is trading at $7.02, but its underlying cash flow-based intrinsic value is $3.85.
It means the stock is trading at an 82% premium to its fundamental value. To justify the current price of $7.02, BBAI would need revenue growth exceeding 30–40% annually, or a massive rapid expansion of gross margins to above 50%.
And the current data suggests neither of those outcomes is imminent, making the stock purely a speculative bet on future strategic execution.
That's the story.
That is a staggering disconnect between hope and arithmetic. On that note, we're going to take a quick break before diving into market sentiment, the fascinating contradictions in ownership, and the geopolitical risks involved. Like and subscribe to Stock Analytics AI.
For $4.999 a month, get 500-plus deep dive videos on all S&P 500 stocks, with NASDAQ 100 coming next, plus members-only requested deep dives.
Part 2, Chapters 4 to 7, Market Sentiment, Ownership Risk, and Final Conclusion. Welcome back to the deep dive. We just established that fundamentally, BigBear.ai is trading at an 82% premium to its calculated intrinsic value. So why is the market continuing to buy the story at $7.02? Chapter 4, Market Sentiment.
This is entirely a sentiment-driven rally. If we look at the professional analyst perception, the consensus is currently a moderate buy, which is typically a cautious recommendation.
Not a strong buy.
Not at all. Their price targets are clustered relatively tightly, ranging from $6 to $8.
The stock is currently trading at $7.02. It's already sitting near the high end of that analyst range.
This is a crucial detail. It suggests that the easy money period, the initial run-up when the market first realized the potential for a turnaround, is largely exhausted.
So analysts are essentially saying the strategy is sound, but the valuation already reflects much of the near-term optimism.
That's a good way to put it.
The public narrative, however, is intensely positive, driven almost entirely by the strategic M&A. The announcement of the Ask Sage acquisition instantly shifted the media narrative from struggling SPAC cleanup to aggressively consolidating AI platform.
The buzz emphasizes the CEO's government access, the $715 million cash pile, and the high-tech angle of agentic AI.
And the reaction to the Q3 2025 earnings is the perfect, almost irrational evidence of this sentiment triumphing over arithmetic.
It really is.
Management had to announce a negative 20% organic revenue decline, a massive failure in current operational performance. Yet the stock still rose 4% after the announcement.
That is the definition of a speculative bet. Investors are completely ignoring the present reality and are focused purely on the future promise.
They are fixated on the 2026 outlook.
Completely. They believe the Ask Sage integration will be flawless, and they are factoring in the guarantee of the One Big Beautiful Bill defense funding. To them, current revenue contraction is just temporary noise on the way to massive future scale.
This bullish sentiment is also confirmed by a critical technical indicator. Looking at the moving averages, the current price of $7.02 is comfortably above both the short-term 50-day moving average at $6.75 and the long-term 200-day MA at $5.29.
More significantly, the chart confirms a golden cross configuration.
Oh, golden cross.
This occurs when the faster, more sensitive 50-day moving average crosses definitively above the slower 200-day average. For technical traders, the Golden Cross is a powerfully bullish signal that mathematically validates the market's belief in a sustained fundamental turnaround, regardless of the poor underlying financial performance we just discussed.
So it gives momentum traders an official green light.
That's exactly what it does.
Chapter 5. Ownership Structure. This section reveals a fascinating contradiction within the investment community. On one hand, we are seeing a clear, substantial institutional quality upgrade, suggesting the stock is maturing.
That's absolutely correct. Throughout late 2025, the biggest passive giants in the investment world significantly increased their positions. We saw Vanguard boost its stake by 32% and BlackRock increase its holding by 18%.
And there was a big hedge fund buy-in, too.
A massive one. The hedge fund Merrick's Group made a huge new entry, increasing its position by over 2,400%.
What does that aggressive accumulation by the largest index funds and major institutional players signal to the broader market?
It signals stability and legitimacy. When funds like Vanguard and BlackRock accumulate, it means the stock is moving beyond being seen merely as a volatile, speculative penny stock.
It's graduating.
It's transitioning toward becoming a legitimate component for certain indexes and institutional portfolios, which provides an undeniable baseline of buying pressure and stability. They are buying the macro thesis, the sovereign AI trend, regardless of the current operational struggles.
But then we hit the bearish divergence. The very people who should know the business best, the insiders, have been net sellers, while these massive funds are buying the potential.
This is the classic red flag for companies built through aggressive M&A roll-ups.
Right.
The people who built the acquired assets, specifically the former Pangiam owners, have been systematically liquidating their stock positions throughout 2025, often selling into the very rallies created by the institutional buying.
They are cashing out their equity just as the biggest funds are betting on the company's future.
That's it.
And it's not limited just to the founders of the acquired companies. We also saw systematic net selling by key internal figures, specifically Director Dorothy Hayes and CFO Sean Ricker, in the second half of 2025.
This is the contradiction every high-risk investor must scrutinize. Why are the individuals closest to the day-to-day operational reality who know the true cost structure, the margin compression, and the difficulty of integration selling out?
While the big passive funds are buying in,
Right. They are divesting at the same time that the large passive funds, who rely more on macro trends and press releases, are buying the story wholesale. It suggests a lack of confidence in achieving the projected margins.
we must also quantify the impact of the capital allocation strategy we discussed earlier. All that M&A funded by ATM offerings has resulted in devastating shareholder dilution.
The dilution has been staggering and cannot be overstated. In just 1 year, the company's fully diluted share count exploded by a whopping 74%, rising from approximately 250 million shares to over 435 million shares.
Wow, 74%.
It's massive, and it means that even if Michelin executes flawlessly and the company doubles its net operating income next year, your piece of the corporate pie, your per-share value, is dramatically smaller than it was a year ago.
It's the ultimate cost of this high-stakes growth strategy. The company gets bigger, but existing shareholders are getting poorer in relative per-share terms.
It forces the company to grow revenue by 75% just to break even on a per-share basis.
Chapter 6, Risk Assessment.
To synthesize everything we found, we need to conduct a structured SWOT analysis, focusing on the most critical internal and external factors that could push BBAI toward either the $7.02 price target or the $3.85 fundamental value.
Starting with the strengths, we have the immense financial stability provided by the $715 million cash fortress, which virtually eliminates near-term solvency risk.
That's number one. Second, the accreditation moat, the ATOs, and security clearances provide a deep regulatory barrier that protects them from agile, younger competitors.
And third, CEO Michelina's deep access to the highest levels of national security leadership in Washington is an invaluable strategic asset for winning those future prime contracts.
Absolutely. The weaknesses are where the bear case lives. First, the dangerously low 22.4% gross margins, which indicate that the core business is barely viable.
Second, the fact that organic revenue is shrinking by 20% shows that the core services business is stalling out or contracting rapidly.
And third, the constant shareholder dilution through ATM offerings fundamentally destroys per-share value, making it harder for the stock price to sustainably rise.
Moving to opportunities, this is what the institutional money is buying into.
This is the whole bull case. The overarching sovereign AI trend fits their cleared niche perfectly, creating massive new spending opportunities.
Then there's the potential for the multi-billion-dollar injection from the one big, beautiful bill in 2026.
That is a massive catalyst that could solve the revenue stagnation problem overnight. And finally, their strategic inroads into international expansion, specifically mentioning partnerships in the UAE and Malaysia, offers a chance to diversify their revenue stream beyond the U.S. federal government.
Finally, we must look at the threats, which are amplified by that 22x sales valuation. Threat number one is the extreme valuation premium, which leaves zero room for execution error.
None. If the Ask Sage integration hits a snag, or if they miss even one revenue target in 2026, the stock could collapse, as that 82% premium dissolves rapidly.
Beyond execution, we have to consider the macro and geopolitical risks unique to a defense tech company operating in the current global economic climate of late 2025. Let's start with interest rates and inflation.
The 10-year Treasury yield is currently sitting at 4.14%. Even though BBAI is cash-rich and not dependent on debt, this high-rate environment compresses the valuation multiples of all high-growth, speculative peers across the market.
So it creates a generalized downdraft.
It pulls BBAI down in sympathy, even if its own performance is fine.
And wage inflation, specifically for cleared personnel, is a direct threat to their lowest margin segment.
Absolutely. The cyber and engineering segment requires those highly compensated, highly cleared engineers. If wage inflation, which is rampant in specialized labor markets, rises faster than the terms of their fixed-price government contracts allow, those already dangerously low 22.4% gross margins will compress even further.
Which could push that entire segment toward operational losses.
It could.
Let's discuss the specific geopolitical risks of 2025.
Huh.
How did the 32% tariffs enacted on hardware imports, particularly from Taiwan, indirectly affect BBAI?
Well, BBAI sells software, but that software runs on cutting-edge hardware servers, specialized GPUs, networking gear. The 32% tariffs dramatically increase the cost of this underlying hardware for the entire defense industrial base, including BBAI's government clients and prime contractor partners.
So if the Army's budget for new systems gets squeezed by those expensive hardware tariffs,
they frequently compensate by delaying or descoping software implementation projects, such as upgrades to G5, creating an indirect but very real risk for BBAI's contract pipeline.
And finally, the export controls, specifically the AI diffusion rule, which limits the sale of advanced computing and AI software to non-aligned nations.
This is a double-edged sword. It creates that protected US-NATO market moat, which is a key strength, but it simultaneously caps the total addressable market.
So they can't sell to everyone.
Right. BBAI cannot sell lucrative technology like Ask Sage to nations like Saudi Arabia, the UAE, or other non-aligned states in the Middle East that are currently spending massive amounts on defense modernization. This restriction limits the potential for the kind of explosive, high-margin revenue growth needed to justify a 22x sales multiple.
We've built the case layer by layer, starting with shrinking fundamentals and concluding with a minefield of geopolitical risks. It's time to bring it all together. Chapter 7. Conclusion.
We have two highly compelling, completely opposing narratives here, and the investor's decision rests on which story they ultimately choose to believe. Let's look at the synthesis of the bull case first.
The bull case is pure transformation and strategic execution.
It is.
The argument is that CEO Mekalinen is flawlessly executing a difficult M&A strategy using the $715 million cash war chest and the game-changing accredited Ask Sage platform to fundamentally shift the company's DNA.
They're evolving from a struggling low-margin staffing firm into a high-margin prime integrator of classified sovereign AI.
And the anticipated 2026 defense supercycle validates the current 22x sales multiple based on the projected reality that revenue will double or triple once the big beautiful bill funding hits their pipeline.
The bear case, however, is grounded firmly in arithmetic and operational reality. BBAI is characterized by shrinking organic revenue, abysmal 22% gross margins, and deeply negative free cash flow. The only reported positive net income was an accounting mirage created by non-cash derivative gains.
And the entire turnaround is being financed by ruthlessly destroying per-share value via a 74% increase in the share count.
And our intrinsic valuation, based on cash flow projections, confirms a massive disconnect, placing the fundamental value at only $3.85 per share.
So if the market price is $7.02 and the fundamental intrinsic value is $3.85, how do we categorize BBAI for you, the high-risk investor?
BBAI is unequivocally a story stock and must be categorized as a speculative buy high risk.
Period.
Its valuation is completely divorced from current financial performance and rests entirely on future strategic execution against immense operational and financial headwinds.
So for the disciplined value investor, the one who demands consistent earnings, high gross margins, and shareholder-friendly practices, BBAI is currently uninvestable due to its low margins and continuous dilution.
Completely uninvestable for that profile. However, for the macro-driven growth investor, the one who strongly believes in the 2026 defense supercycle, accepts extreme volatility, and is seeking a pure-play vehicle in classified AI, BBAI offers that high-risk, high-reward call option.
And the $715 million cash pile acts as a strong downside floor, preventing immediate catastrophe while the strategy plays out.
It's their safety net.
Here is the final provocative thought we leave you with, which goes back to the insider-institutional contradiction we identified. Why are the people who built the acquired assets, the former Pangiam owners, the CFO, the director, systematically selling out their positions right at the moment when massive, highly sophisticated funds like BlackRock and Vanguard are massively buying the potential?
What operational difficulties, what margin compression realities, or what execution risks are the people closest to the operation aware of that the large, slow-moving institutional funds are only just starting to price into their models? That is the question that must guide your final research before making any decision on BBAI.
That's a deep dive that should keep you busy. Thank you for diving deep with us today. Like and subscribe to Stock Analytics AI.
This analysis was generated by an AI system, synthesizing public financial and strategic documentation for educational purposes, and should absolutely not be considered personalized financial advice.
Yeah.
Please conduct your own thorough research or consult with a qualified financial advisor before making any investment decisions.